Thank you for joining us today for another My Wealth webinar. My name is Jeff Hunter. I'm an associate investment advisor with Dave and Rahim, who are our lead advisors on the team. I'm as well a portfolio manager and help look after the My Wealth discretionary portfolios. Today's a really exciting call. A staple in many of our portfolios is Forge First and their alternative strategies. We have Andrew McCreath, who's a CEO and CIO at Forge First. He's also a well-renowned BNN commentator. So these are times where I'm pretty excited. He's got a very depth knowledge of all types of the market. So Andrew, thanks a lot. If you want to just briefly give us a quick backdrop of how you got into the business and where you're at today.
Sure. Well, thanks very much, Jeff and Rahim and Dave. It's great to be here with you today. We're just joking how I'm one block away from where you're sitting, but so much in the virtual world today as opposed to the real world. Anyway, it's great to be here and to be with your clients and guests. I'm, of course, looking forward to answering any questions that any of you may have as the call evolves. It would be my intent to introduce the Forge First team to you and then discuss markets a little bit. I will get into some macro, talk about interest rates, talk about foreign exchange rates, talking about stock market performance. Yes, we'll bring the election in the United States into the equation. And then we will talk a little bit about a conclusion about the outlook for financial markets. And of course, I will tell you briefly a little bit about one of my two funds that I have at Forge First called the Conservative Alternative Fund. As for your question, Jeff, I've got a bit of a different resume, shall we say. I was in the rock and roll business for 10 years before I went to university and did an undergraduate degree in finance, a master's in economics. And you know what, Dave? It's not too much in the future that I will hit 40 years in the investment business. So I don't think I can tell people that I'm 39 years of age anymore, but I'm not worried about it. I just want to keep getting older. As for Forge First, I started the business with my co-founding business partner, Fatima Harani, just under 13 years ago. At that point in time, we launched two funds. It's the same two funds and the only two funds that we manage today. And one is called the Conservative Alternative Fund and one is called the Long Short Fund. We seeded the funds with a little less than $3 million of partner capital back then. And today we're fortunate enough to manage $1 billion of client capital. And our funds are sold, at Canaccord, and they offer daily liquidity, so you can buy them and sell them on a daily basis. They're sold via prospectus. There's no funky forms you have to fill out, and the minimum investment is $500. And of course, they're RSP eligible. So it's pretty simple to buy and yes, to sell our funds. With respect to what we're trying to do at Forge First, we are attempting to generate a competitive net return and protect capital when markets get rougher. We both know that there's a lot of silly phrases such as the best way to make money is not to lose money. The tortoise beats the hare. Slow and steady wins the race. I believe in all of them, and that is what I built the recipe for managing client capital at Forge First around. I would say we've done a pretty good job at meeting those goals over the last 12 and a half years. What I'd like to do, Jeff, is share my screen. Very high tech for an old guy like me. Where are we here? Where's the option to share my screen?
It's the green upward arrow on bottom.
Yeah. Oh, there we are. Yeah, great. Okay, even I can figure that one out. Now, there's two-sided papers, so you'll have to excuse me here. But I'd like to veer your eyes to the left side at the top where you see five guys. Up top, you see two portfolio managers. On the left, it's Keenan Murray, who's the manager of the Conservative Alternative Fund, which represents about 56% of our total assets under management of roughly $1 billion. And then on the right-hand side is Richard Roth, who's responsible for our long short fund. Below are some analysts and our trader. The fellow in the bottom right, Taylor Merritt, lives in Calgary, and he is a chemical engineer from the University of Alberta. He joined us 2.5 to 3 years ago. He had been working his previous 9 years at Keyera for 6 and Pembina for 3 years before his 6 years at Keyera. Needless to say, he covers energy and industrials for us. The fellow in the middle at the bottom is our tech analyst. He joined us a year ago. He had spent his previous 20 years being an institutional technology sales specialist at a U.S. investment dealer. He knows technology inside out. And recently we posted a webinar where I interviewed him with respect to artificial intelligence. You can find it on our Twitter account, on our LinkedIn account, forgefirst.com. Of course, is the handle, shall we say. It's not a .com as it relates to a LinkedIn address or a Twitter address. At the bottom of the page, I'm showing you how we manage money at Forge First. It's all about having a repeatable process. So we're not into private companies. We're not into small cap stocks. And we've been investing throughout North America since day one. Because to have a repeatable process, you have to have a very liquid book. In other words, a very tradable book of securities. We also always have a good size short book because our goal, as I said, is to generate a competitive net return, protect capital when markets get rougher. Well, when markets get rougher, it's hard to protect capital if you're 90% net long or 100% net long. Simple fact of the matter is, if the market goes down, you're going to go down. So we manage long short strategies where we own stocks we like and we short stocks we don't like, to put it simply. And we also use a lot of listed options to further hedge market risk. For example, we have a lot of protection on ahead of the election. We put it on a few months ago. And yes, you could argue retrospectively, given how the market has acted the last 6 weeks, you really haven't needed it. But again, we stay focused on executing on our mandates. And I, as the boss of the company, stay focused on ensuring that the team sticks to the rule book that I created almost 13 years ago. Shifting over to the right-hand side of your screen, it is a little tough to make it bigger. Suffice it to say, I'm going to circle the graph here that I'm showing you. This is a year-to-date index graph. In other words, on the left-hand side, it starts in January of 24. And each of the 3 lines, which are the M7 stocks in white, or the Magnificent Seven, Apple, Microsoft, Google, Amazon, Facebook. Sorry, I don't like Meta. I'll call it Facebook. NVIDIA. That's the white line. The yellow line are the other 493 stocks in the S&P 500. So I call it the S&P 493. That's the yellow line. And then the red line, the dark line, is the Russell 2000, which is a proxy for small cap stocks in the States. But of course, a small cap stock in the States is a mid cap stock up here. They'll call a 3 or 5 billion market cap company a small cap stock in the States, whereas we would call that a mid cap stock. As you can see, look at the top right-hand corner of this graph. Bottom line is, while we were seeing a broadening out of the market for a couple of months over the summer and early fall, we're right back to where it's the Magnificent Seven or the M7 stocks that are driving the markets. That is why you see the white line gapping higher in the top far right-hand corner of your screen. You can see the yellow and the dark lines. They're up this year, no question about that, and their performance improved over the summer, but they haven't been doing a heck of a lot as of late. The graph below that is kind of interesting because it's that same S&P 493 x the M7, right? Against the TSX, the Toronto Stock Exchange. And again, this is a one-year graph as opposed to a year-to-date graph, but look at the fit between those two lines. When I first made this graph, for those of you who remember from when I was hosting the Weekly with Andrew McCreath show, I love my graphs. I think a picture speaks 1,000 words, and I've got lots and lots of graphs in my Bloomberg machine. And that's one of the things I do for a living is I look at pictures. But when I first created this graph, I was surprised at the uncanny relationship between the two lines. And please note that it is not adjusted for currency. In other words, the TSX is in Canadian dollars and the S&P 493 is in US dollars. Shifting at the market itself and the valuation of the stock market, you can see that I would argue stocks are not cheap. Arguably, they remain expensive. In the top left-hand corner of your screen that I'm circling right now, the white line is the price earnings multiple, a valuation metric for the S&P 493 against interest rates. Here, I've used the yield on a 10-year US government bond, but note, I've inverted the line. So in other words, a falling line, a falling red line, is a rising interest rate. But you can see how, well, historically, there's been a correlation on this 6-year graph. Recently, on the right-hand side of the graph, the two have completely decoupled. And interest rates have been, moving higher with a 10-year bond yielding 4.25 in the States today. But the white line has kept marching higher to the point where the white line is up at a little over 22 times earnings for the S&P 493. Now, old guys like me remember that you used to want to buy the market at 12 or 13 times earnings. Well, okay, so why don't you add 3 or 4 multiple points for the fact that we have these cash flow machines called Microsoft and Apple. And so the 12 or 13 becomes 16 or even 17, but the market's at 22 times. So the market seems a little rich to me, and you've got to be very selective at this juncture. We're not talking, this conversation is not occurring 3 months ago, it's occurring today. And the market's trading at a little over 22 times earnings when you exclude those big 7 tech stocks. Shifting back to Canada for a moment, I thought this picture would be worth including, and it is showing the indexed year-to-date performance of what have historically been called bond proxies, telecom cable stocks, that's the red line, utility stocks, the yellow line, and real estate stocks, or REITs, the white line. And the vertical white line in the middle of the graph marks July 1st. So we're, of course, on the right-hand side of that line now, and the first 6 months would be on the left-hand side of that vertical white line. But you can see that these stocks, which have typically been owned by investors instead of owning a bond, and whose shares have typically seen their prices move in line with interest rate changes, the telco and cable stocks have completely decoupled from the other two lines. We know the reasons why. The telecom and cable companies here in Canada effectively are losing their business, and they're all going to become dumb pipes that effectively just the data comes through to your home, to your phone, but the value add that they used to offer is going away. And it's been particularly bad for those stocks. And so my 2 cents worth is if you want yield, you don't buy the 9% yield at Bell because it's probably safe for the next 18 months, maybe 2 years since they sold the $4 billion worth of sports franchises. But at a point in time, it's going to become problematic. You can see the other two lines, utilities in yellow and real estate in white, are pretty much tracking each other and clearly have benefited from investors selling telco stocks and buying the other ones. Moving over to the top right-hand side of your screen is what we call our U.S. Macro Liquidity Index. And we calculate that by taking the size of the balance sheet of the central bank of the United States, and we add to it changes in the balances of reverse repo agreements and changes in the checking account of Janet Yellen. It's called the Treasury General Account, or the TGA. Bottom line is, you can see in the middle of the graph here how the white line went way up during COVID. And to my surprise, here we are today. Excuse me. The line has hardly gone down. Liquidity is still huge. So not only have we seen 6 to 7% fiscal deficits in the United States, which clearly has driven growth, but we also see a U.S. environment that is swimming in liquidity. And notwithstanding the fact that the Fed told you a couple of years ago they were going to shrink liquidity, there's still lots of it out there. And that, in addition to supporting growth, clearly is supporting asset prices. Now, if you look at the last year and you look at money market assets, you have seen a reduction in reverse repo balances from $2.5 trillion to $250 billion, a decline of 90%. Where did that money go? It went into treasury bills. How did Yellen finance the majority of the fiscal deficit of $1.7, $1.8 trillion in the States last year? By selling treasury bills. So the money market funds took the money out of reverse repos and went and bought treasury bills. But there's a problem. If the deficit's going to be another $1.8 trillion over the next year, where's that money going to come from? Well, it's not coming from reverse repos, because reverse repos are down to $250 billion. And some people are of the view that it won't go any lower than that. Bank reserves, commercial bank reserves. Yes, they'll get $600-700 billion out of that, but that still leaves a lot of money that's required. So what's going to end up happening? Well, you know how the central bank in the United States has been running their QT, or quantitative tightening program, where they're buying fewer and fewer bonds, or not reinvesting as much of the proceeds from maturing bonds into new bonds. Well, they're going to end up ending QT at some point during the next probably 6 months. And that'll be a source of another several $100 billion. But ultimately, the game's got to stop. And why are interest rates going up now? Well, one, because inflation is still there. It's come down a lot, but we'll talk about inflation in a moment. It is still there on the service side. And then secondly, the market is starting to worry about who's going to finance the future deficits beyond 2025. As you know, even the Wall Street Journal, which it's unlikely that the Wall Street Journal will endorse Kamala Harris, but it's likely that they will, frankly, they already have, endorsed Donald Trump. Notwithstanding that, they ran an article a couple of weeks ago that suggested that over the next 10 years, under Trump, the deficits would be, on a cumulative basis, $10 trillion higher than they would be under Harris. So the market is pushing interest rates higher, long-term interest rates higher, like 10-year yields, 20-year yields, 30-year yields, because they're worried about how that deficit is, how the accumulated debt will ultimately be financed. The U.S. is adding $1 trillion in debt every 3 to 4 months. Now, at the bottom of what you see on your screen, in the bottom right-hand corner, I'm showing you, since 2013, on the far left-hand side, the two supercores, the annual rates of the two supercores, specifically CPI in white, Consumer Price Index in white, and PCE, or the Personal Consumption Expenditures Index, in red. Now, when we call them supercores, that is the phrase that is used to describe the inflation metric excluding food, energy, and real estate, rent, for example. So when you look on the right-hand side of the screen, yeah, they both come down, Neither one of them is anywhere close to where they were for most of the previous 10, 12 years. And please note how the red line, has begun to tick up a little bit, but the white line still is at 4% on an annualized basis. So yes, inflation's come down a lot, but it hasn't gone away. So what does that mean for interest rates? So in the top left-hand side of your screen here, I'm circling a graph that shows you the yield on a 10-year US government bond. Now, that is called the nominal yield, and it's the red line. The white vertical bars represent end of calendar years. The far left-hand side of the graph starts at the beginning of 2017. So call this a roughly 7-year graph. And as I said, the right line is that headline yield, which today is about 4.25% on a 10-year bond. To get that red line, you add together the white line and the yellow line. The yellow line is the break-even yield. Let's consider it a proxy for inflation. And the white line is the real yield, something which I would argue is a very crude proxy for the supply and demand of credit for that specific nation, in this case, the United States. Now, when you look at the far right-hand side of this graph, you can see that the white line has started to go up again, and that has been the big driver of the red line going up. My comments on the previous couple of slides about future deficits, who's going to finance that deficits, that, in my opinion, is why the real yields go up. And it's the key driver why I believe long-term interest rates will only go down to the levels that the big bond bulls talk about. One could be a guy named David Rosenberg. If we see the economy absolutely dive into a bad recession. Otherwise, I believe long-term bond yields stay higher for longer. In fact, I write a monthly commentary that you can find on our website, forgefirst.com. They're typically posted the morning of the 6th business day of a month. And when I post my one during the first week in January, it represents commentary on the performance of our two funds for the month of December, but it also includes my look ahead into the next year. And recently I was looking back at sort of the 10, 12 variables that I expressed an opinion on. And one of them was to do with bond yields. And I said that 4% would represent a floor on a 10-year US government bond. Now, you all know that I was wrong for, 4 weeks or whatever, when yields got down to 365, but they're back up to 4.25. And I'm likely to stick with that opinion into next year, unless the economy goes into a big recession, which I don't think it's going to in the States at this point in time. So I think interest rates stay higher for longer, and longer rates maybe go even higher, while the short end comes down because, yes, the central bank will be cutting interest rates, although nowhere near as aggressively as we're going to see here in Canada, or we have seen and will continue to see here in Canada. Okay, what about the election? Well, all these graphs were made yesterday. So yesterday evening, I should say. And so consequently, this graph in the bottom left-hand corner is about as current as you can get. Now, of course, it's only one opinion poll. But as you can see, it is who will win the US presidential election. And the white line is Harris, and the dark red line is Trump. And you can see on the far right-hand side, look at the divergence here that really started kicking in at the beginning of October. And then now recently you've seen Harris go up a little and Trump go down a little. Who the heck knows what is going to happen? I mean, when you look at the US presidential election, you probably know all the variables that are likely to be impacted by who wins, but especially who controls Congress, whether it's split or whether it's a Trump sweep, will play a significant role on impacting how these variables will actually shift relative to expectations. I'm talking about trade, immigration, fiscal policy, regulation, inflation, labor, economic growth, and the deficit. Those are the variables that are going to need to be taken into consideration. No question, if there's a Trump sweep, deficits will become problematic, and hence that's why we've seen interest rates move higher. And I'm going to show you a picture on that in a moment. Regulation will undoubtedly be eased quite materially so, which you could argue will enable more mergers and acquisitions activity. But of course, it'll also create more powerful oligopolies. So, pick your poison on what you want. And as they say, be careful what you wish for. As for deficits, Trump is considered to be more challenging for deficits. In other words, much more willing to run much bigger deficits than Harris would. But who the heck knows what's going to happen? It's, of course, a week today that we have the election in the United States. Now, I mentioned I was going to show you a picture about interest rates and Trump. So let's look at the top right-hand corner of your screen. I grant you this is a very busy graph because I'm well aware that you don't have an 8x11 picture of it right in your hot little hands. But this graph starts at the beginning of June. The white line is the probability of Trump becoming president. The yellow line is that break-even yield I referred to a moment ago. It's the yellow line. And then the red line, the dark red line, is the number of US dollars that you get when you buy a euro. Look at the right-hand side of the graph. Notice how all three lines are moving up in sync with each other. Why would that be? Well, two reasons. One, it could be a fluke. And two, and more likely, it has to do with the comments I've made about Trump and deficits and Trump and trade policy, both of which are believed to lead to a rising US dollar. And that's what you're seeing on that graph. At the bottom of that page, on the bottom right-hand corner, I'm showing you a graph. It's a 1 year graph as opposed to a year-to-date graph. So it's 1 year. And the red line is the US dollar as measured by the Dixie, if you will, which is a basket of currencies, 58% weighting to the euro, and of course, the yen, the Canadian dollar, the British pound, etc. are in it. And the white line is the number of rate cuts that are expected from the Central Bank of the United States by December of 24. Look at the far right side of the graph, and you can see that the rising line means fewer rate cuts are expected from the Fed. And of course, the rising red line is a stronger US dollar. And as you would expect, if the markets expect fewer rate cuts by the Fed, in other words, interest rates staying higher for longer, then the dollar becomes more valuable. And that's what we're seeing. We have seen a lot of reports over the last 6 months saying that the dollar is going to go down, because of deficits and all that stuff. But the fact of the matter is, the US economy continues to do very well because the fiscal deficit is so high. How can you have a recession when you got a government who can finance it, running at 6 to 7% of GDP? There are folks that complain about what's going on in Ottawa. Their deficit is peanuts compared to the US deficit, not in absolute dollars, because obviously that's not a fair comparison, but as a percent of GDP. We're down to something like 1.5%. They're up at 6 to 7. So it's hard for an economy to weaken a heck of a lot. Meanwhile, China is structurally challenged and not going to get a heck of a lot better. And Europe, very simply, is a mess. And it's been a mess since the financial crisis in 2008. And back when I was on BNN, I could never believe the number of folks that would get on that TV station and tell investors to go buy Europe. Why? It's a structural mess, and it's not getting any better. Okay, so speaking of interest rates, let's move to the top left-hand corner of your screen. And this shows you the number of rate cuts that the financial markets are pricing in for the end of 2025. And once again, the rising white line means fewer cuts as opposed to more cuts. And so what I'm circling here is September. And bottom line is you can see fewer rate cuts are now expected by the end of 2025. So fewer rate cuts equals higher interest rates, which of course helps to cause the US dollar to be stronger. So what about the loonie? Well, one of those other predictions that I said in my year ahead 2024 commentary, which you would find on our website, forgefirst.com, was that the Canadian dollar would hit 70 cents. And of course, I've been wrong so far. It's threatened moving below 72 a few times, but it's finally only through 72 cents to the downside over the last couple of days. In fact, I think it's trading at around 71.80 today. I continue to believe that there's a pretty high probability that the Bank of Canada cuts another 50 basis points in December. And we'll undoubtedly get 125 basis point cut from the Fed. And we'll get two if this Friday's jobs report is weak and December's jobs report is weak. But there is a chance that we only get one. Bottom line is, I think the Bank of Canada will cut another 100 basis points from the 125 they've already cut over the next 4 months. So as a result, when you look at this graph here, look in the bottom right-hand corner. What is the red line? The red line is the difference between a 2-year yield on a Canadian government bond and a US government bond. And as you can see from the text here, I've taken the Canadian yield and I've subtracted the US yield. Well, when you look at this line here, you can see the red line is deeply negative. And in fact, the red line is on the right vertical axis. And I know it's too small for you to see, but the interest rate differential is a full 1%, 100 basis points, and it's in favor of US interest rates. US interest rates are 100 basis points higher at the 2-year duration than Canadian rates. So what does that suggest about the Canadian dollar? Well, you can see there's a pretty good fit between the red line and the white line being the Canadian dollars per US dollar. Look inside the yellow oval at the bottom right-hand corner. Well, the white line is still up here and the red line is down here. I kind of think the Canadian dollar is going lower. I'll stick to my 70 cents. If I'm wrong, I'm not worried about it. I'm not a currency specialist. I've got an opinion, I'll express it to you, and I'm glad to admit when I'm wrong. But I think the Canadian dollar goes lower. And so what do speculators think? Speculators will go out and get involved in the currency futures market. Well, they certainly think it's going lower too. That is the graph in the top right hand of your screen right now. The red line is the number of Canadian dollars per US dollar in this graph that starts in the year 2012. So it's a 12-year graph. The white line is the net positioning. In other words, the number of folks that are long minus the number of contracts that folks that are short are short. And you can see that the white line is down here. It's not up here. And meanwhile, the red line is higher. I think the Canadian dollar goes lower. I figured I'd show a couple of energy graphs since we are in Alberta. And the first one in the top left of your screen is oil. The white line is the 24 strip for West Texas, and the red line is the 25 strip. Not exactly beautiful pictures. We're net neutral in our energy book, maybe 1% net long, but that would be it. Our favorite oil stock is Athabasca. I mean, it's not doing well today, that's for sure. But the fact of the matter is, it is a company that's going to return 100% of its free cash flow over the next few years to investors. It's going to grow its production by 50% over the next few years. And it's going to buy back 1/3 of its stock over the next few years. So the production per share a couple of years from now, as a result of those three items, is going to be markedly higher than it is today. So over the medium term, we think this stock does very well. But I'm in the who cares camp for oil. I think there's too much supply. And I also believe, which is going to grow next year, by the way, you've got 2 South American countries that are growing their production. You've got all the inventory in the Middle East, and even Canadian oil production is expected to grow by 300,000-400,000 barrels a day. Meanwhile, on the demand side, Chinese oil demand is down 8% year over year. That is the big marginal buyer of oil. And as I said, their demand growth is down 8% year over year. Below that is the NYMEX gas strip. I thought I'd show NYMEX as opposed to AECO, because AECO obviously gets better next year with LNG Canada, which probably doesn't go commercial until next year, but they will start, shipping some gas before the year is out. And as you know, they've been filling the pipes. But the 24 strip is the white line, and the 25 strip is the yellow line. You can see neither of them look particularly healthy. You do have to take into consideration that if Trump chooses to get aggressive on tariffs, you could see some challenges with respect to forward demand growth for LNG exports out of the United States, which would not be good for the quote. So with respect to markets, what do I think? Well, we're sitting here having this conversation today with the S&P trading at, 58.50, 58.70. It's been a really good year in markets. What's the next 12, 15 months look like? Well, I expressed the opinion that the U.S. economy's okay for a while longer because the deficit is so big and there's so much liquidity. The second variable that keeps the U.S. economy going okay is the amount of money the top 15 to 20% of the population have. They've never been wealthier because 90% of the stock market is held by the top 10% of the population of the United States. And the stock market's gone up. Obviously, there are people that own multiple homes and have benefited the most from low interest rates over the last few years, up until when they started going up 18 months ago. And you see it in the bifurcation of company financial results, the winners versus the losers. You see it in the default rates for auto loans. Default rates for auto loans are back at, global financial crisis levels, but it's only in the lower tiers of the economy. They're suffering like they've never suffered before. But the absolute number of people that have money in the States now is big enough as a percent of the population to drive consumer spending. The top 20% of the US consumers represent 40% plus of consumer spending. So the US economy is going to be fine for a while. And consequently, we'll have some earnings growth next year. Is it going to be the 15 to 20% that people are calling for? I find that a little aggressive. I also think the number of interest rates cuts that are expected may end up being aggressive. And most importantly, I do believe bond yields stay higher for longer, especially if we're going to continue to see gargantuan deficits in the United States. Because who's going to buy those bonds? Yeah, there's a price, But of course, the price means a higher yield. The Chinese aren't buying them. The Russians aren't buying them. Middle Eastern countries aren't buying them. So you have to take that into consideration. So when you have the market trading at 22 times for the 493, my suspicion is stocks are fine for a little while longer, but they become more challenging the further we get into 25. And I also don't think cycles have gone away. I'm not saying, I'm not saying that the US is not going into recession right now. I think the Canadian economy is in much rougher shape than the US economy, because when you look at the debt to personal disposable income ratio in Canada at 185%, that same number in the States is 90%. It's half the number. And yes, it is not an accurate reflection of the average person because of the wealth of the rich. But bottom line is that's a big spread, 185 to 90. So I think stocks, you continue to own stocks, but the waters are going to start to get choppy next year. And consequently, you need advice. I've had the good fortune of working with Jeff, Rahim, and Dave for years, with you being a client of mine. And I know they are rigorous of me in their analysis of my funds, their questions of me on how the funds are managed. So I know they know what they're doing. And I encourage you to realize the fact that, you know what? It's been kind of easy the last few years, but looking ahead, it's likely to get a little rougher. And so that advice is worth its weight in gold. What about bonds? Well, I don't like bonds. I've explained why I don't like bonds. And so the one last slide I will show you is my conservative alternative fund. And this is on the right-hand side of your screen. What I'm showing you here, this is a fund that, since it became a daily liquidity liquid alt 5.5 years ago, the strategy has a 12.5-year track record, but it only became a liquid alt 5.5 years. And I am not allowed to mix performance of the previous versus the current, even though it's run the same way. But the 5.5-year track record has a roughly 9% net compound annual growth rate, net, in other words, after all fees. It has 0% downside capture, meaning that on average, historically, it's not a forecast. If the market has been down 100 basis points or 1% in a month, this fund has been flat. Here I've shown it against balanced funds, the popular balanced funds in Canada. You know, a fund that might be 60% stocks and 40% income. And again, I know it's difficult to see on the screen, but please chat with Rahim, Dave, Jeff, if you choose to do so. Bottom line is the risk metrics and the return metrics are far better for this fund than they are for all the balanced funds on this table. And then at the bottom here, I'm showing you a page from a Morningstar report, 5.5 years length of data in this graph. And the left vertical axis is return, and the horizontal axis is risk as measured by standard deviation or volatility. This is my fund right here. This is the conservative fund. So a higher return and the least amount of risk. That's where it's sunny. And that's the conservative alternative fund. Jeff, Dave, Rahim, may I pass the ball over to you?
I think if we look a little backwards a little bit,
Sure.
we have had some rockiness in 22 in particular. I always kind of think of you guys as the low rising, smooth, steady to the right, and a little bit higher in terms of returns. So low volatility, consistent rate of return. We had that rising rate environment at a pretty extreme component. We had a lot of money coming out of the Mag 7s, which a lot of people have forgotten now. But how is the flexibility in your turn or in your funds what type of flexibility do you have to generate a positive, low volatile return in a year like that, and then continue to drive forward in stronger years like this year?
Well, this investment strategy, which, as I said, has a 12.5-year track record, made money in 2015 when the markets went down. It made money in 2018 when the markets went down. And then the liquid alt version of the same investment strategy made money in 2022 when the markets went down. So talk is cheap. I would suggest to you that the fact that this strategy has made money in each of the last 3 years that the markets went down probably answers your question. Obviously, I would never promise or even imply future returns, but your team knows that we always run with a gross short exposure of, call it 50 or 60%. I'd like them. I'd like the market to go down. I do not want it to go down 20% in a day, but I would love for it to go down, 2 or 3% over the next couple of weeks. But that's a selfish statement. I realize that, Jeff.
Can you just touch
So,
on your Sortino ratio as well? Because a lot of people don't really publish that, and why that. It's one of my favorite factors when dealing with clients.
so when I look at the table that I was showing your listeners, the Sortino ratio of this fund is 1.68, whereas the Sortino ratio of all those balanced funds is roughly 0.4 to 0.5. And of course, our Sortino ratio, shows you the amount of return you get on a per unit basis for each unit of risk that you're taking. So it's not about how much money did you make me, because, do you want, let's say you have two funds and they both start here and they both end here. Well, do you want the fund that does this, or do you want the fund that does that? I think nine and a half out of 10 people will want the second fund. The slow and steady wins the race. And that's what we're all about. As I said earlier, the best way to make money is not to lose money. And again, this fund made money, the strategy, I should say, made money in each of the last 3 years that the market went down. And it's got a 9% net CAGR and 0% downside capture. Hopefully that answers your question, Jeff.
Rahim, Dave, and anyone in the comments or in the audience, we have a Q&A button at the bottom. Feel free to type anything
Andrew,
in.
it's Dave. I've got a quick question.
Yes, sir.
I'm looking at the transition team that's coming in with Trump, and you've
Yep.
got, Howard Nuttlick. Like, you've got some pretty serious people here that are talking about, along with Elon Musk, how they're going to cut spending in America. How do you think that that's going to turn out?
Well, I mean, obviously, I don't want to cause people to get irate with me and get into politics on this call, but with respect, I would suggest that you really don't have a clue what President Trump might do if he got elected or if he got a sweep. He talks a lot. I mean, he's talking about eliminating taxes for a lot of people, right? Every week he's throwing in a new group. Well, you got to pay for it somehow. And I mean, if you want to just make the rich richer and the poor poorer, I probably won't be around. But ultimately, it'll lead to civil war. It always does. So I don't know. I take most of what he says with a grain of salt, because you have to see what he ends up actually doing versus just talking about. The other thing you have to take into consideration is, remember, the president cannot unilaterally change tax rates and things like that. So I would think, frankly, I hope, and I'm showing some stripes here. I mean, I would consider myself a little right of center fiscally and a little left of center socially, not extreme in either direction. But you've got a lot of, dare I say, non-Trump Republicans in Congress who would likely not support the extension of the tax cuts, to name one example. And you know what? If he wants to nail China to a wall, well, his voting base are the ones that are going to get hurt. Because where do you think Walmart gets all their stuff? China. You'd sort of think Walmart would have a little bit of a lobbying force in Washington. You'd kind of think, right? But I also find there's so much hypocrisy. I mean, there's hypocrisy in Canada too, lots of it, and in the provinces. Let's face it, Dave. But you look at what NVIDIA, the chips that NVIDIA has been shipping. I mean, why are their chips still getting into China? I read a report 9-10 months ago talking about their chips getting into China. Well, why is that happening? I mean, talking out of both sides of your mouth. So I don't know what to make. I mean, I guess is really the answer to your question, Dave. Because yeah, you're right. He's got some pretty hardcore far-right people as potential high-level influencers of government policy. And given that the US is the dominant economic player in the world, I find it very scary. I mean, America needs our water. You know what? Sorry, you're not getting any.
Just one other,
Yeah, go ahead,
quick
Dave.
one here. Sorry. We just had a question for a listener. Price of gold. Are you a gold bug at all here?
We have a modest exposure of gold in the conservative alternative fund. I would say to you that it became completely uncoupled to traditional variables that it was correlated with 2.5, 3 years ago. And that's when rogue central banks started buying it. You know, de-dollarization and all that stuff. Now, the whole macro trend of de-dollarization is a bit of a joke in the sense that still only about 3-4% of global trade doesn't occur in, or let me rephrase that, 3-4% of global trade occurs in the renminbi. So it's not like there's been a sea change going on. Will it change in the future? Yeah, undoubtedly it will, but it's beyond our investment horizons. More recently, gold clearly has been benefiting from the fear of deficits, the printing of money, and all that stuff. You know, I think that gold has a place in a portfolio. I would argue that the vast majority of gold stocks are either companies that are very poorly managed, similar to many other Canadian companies, or they're just promotes. And we don't own shares in Agnico Eagle. I mean, that is clearly the class act, and you pay for it. It's like Royal Bank. You pay for it, but it's the class act. But I think it depends why you get involved in gold. And if you're an individual investor, you may be involved in gold because you may think of it as a safe haven. And in that case, I'd probably just own the bullion as opposed to a stock. And as for owning it, yeah, as I said, I can understand why somebody would continue to own or even initiate a small purchase in gold at this juncture.
That's a great answer.
Same would apply to cryptocurrencies, but like marijuana, back in 2017, I was not a believer in marijuana. I thought, look, it's just a crop. What's so special about it? And of course, the stocks went to the moon and then they crashed down to earth. I never understood why the Central Bank of the United States would allow the crypto ecosystem to develop. Bottom line is they did. It's there, and it's too big now to do anything about. And I don't pretend to know about it, but one has to consider it highly speculative. As an older guy, it is my sense that it is a market that remains highly vulnerable to manipulation, and fertile land for, shall we say, less than favorable activities going on. Doesn't mean it may not be a good investment for a small portion of one's portfolio if in fact they believe the US is ultimately going to blow up because of debt, which it's not going to happen next year because there's no alternative to the US dollar, but hey, maybe in the future it will.
Great answer. Rahim, you have anything further?
I believe we're out of time, but just any comments on Canadian housing and potential political strategies that continue to pop out of Ottawa. Any thoughts there? And that's it.
Well, it was interesting reading the news today how Poilievre has come out and said, why don't you just cut the GST on new housing? That seems pretty simple versus the relatively convoluted strategy that the current federal government has been putting in place. But when it comes to housing, I think that is why the Bank of Canada is going to be aggressive at cutting interest rates. Back in the global financial crisis, the dirty little secret about Canadian banks is that the federal government bought $125 billion worth of mortgages from the Canadian banks. So it doesn't matter who's sitting in the chair in Ottawa, but the federal government will bail out the Canadian banks at whatever happens. So if interest rates had stayed high, 5.5% overnight rate in Canada during 25, there would have been problems, absolute problems in the mortgage world, in residential housing, big problems, and it would have become a growing problem for banks. With rates now coming down, the risk of that problem is also coming down. And so I do believe that you're going to continue to see in the near term, better rental price growth for rental units in, shall I call them, tier 2 cities, like a Halifax, like a Winnipeg, etc., than you will in Toronto, where rents are actually starting to go down. But obviously, with probably an 18-month lag, and I'm just pulling that number out of the air, Rahim, that'll go away as future immigration numbers start to come down. And the bottom line is, if you are financially leveraged in a house in an area that is not growing its population, there definitely remains the risk of there being problems in those areas. In the major markets, I don't think that's going to be a problem, because there's so much demand to be in those major markets. So I don't think we're going to have a big housing problem in Canada, to put it simply, because interest rates are coming down and are going to continue to come down. That's the bottom line. But there will be problems along the way. And when investors look at private credit, you have to be exceedingly selective at looking at the asset liability mismatch, or matching, I should say, in a private credit vehicle. And of course, you have to look at where their assets are located. But I think what you're asking is a little more macro than micro, Rahim. And I would say to you, I don't think we're going to have a major residential housing problem in Canada.
Thank you so much for your time today.
You're very welcome, gentlemen.
Yeah, we
Your listeners
for all
know
those
they
on.
can read our commentaries at forgefirst.com if they choose to do so. And if they share my views that the markets, have been pretty good the last few years, there can be some challenges looking ahead, then I certainly can speak to the wisdom, integrity, and intensity of analysis of your team.
Thank you very much for that. And for those on the listening, we'll have a record of this sent out in a couple days' time. Also include some of the links that Andrew talked to us about, so that you have them for your own reference. Post-election, November 7th, we're going to have Ben Fawcett, our internal portfolio manager, as well, speak with us after it's all unfolded, hopefully. If it's concluded by then.
Andrew, Dave here, thank you very much for your time. We know it's
You're welcome.
valuable and your insight.
You're very welcome.
Have a
Take
great
care,
day.
Rahim.
Thanks
Thank you,
again.
gentlemen. Bye all.
No, thank you.